Hello guys, today we will talk about Plus500 and we will try to answer to the following question. Is Plus500 interesting to buy right now for a value investor? First, what is Plus500? Plus500 is a global fintech company based in Haifa, Israel and founded in 2008. They are listed on the London Stock Exchange market. This company operates in more than 50 countries with a suite of trading platforms and subsidiaries worldwide. What do they do? This company offers an online trading platform for individuals to trade CFDs, contracts for difference. These are financial derivatives which let traders bet on the price movements of various products, such as stocks, cryptocurrencies, currencies, and even more. You never actually own the asset. You are just betting on its price movement over a chosen period. While you can hold your position for a long time, you will usually pay an interest-like fee, overnight financing, which makes these products better suited for short-term trading. Let's say you buy $10,000 worth of S&P 500 CFDs using a 10 times leverage. It means you only put in $1,000 of your own money. The rest is effectively borrowed. Imagine now if the overnight fee is 5% annualized. The daily fee is then 9,000 multiplied by 5% divided by the number of days in a year, and we arrive at $1.23 per day. That might seem tiny, but keep it for a year and it becomes $449 in fees, near half your initial capital gone just to interest, even if the S&P stays flat. Sometimes and often the product you buy has some constraints. For example, you may have a barrier, a kind of a low price, at which you are forced to sell if the product reaches that price. In the case of a short-term dip, you could be forced out at a loss before your long-term vision plays out. Once again, taking an example, you put $10,000 on a 10 times leverage CFD related to a product. It might be stock, crypto, whatever, with a unit price of $100. You have then 100 units at $100 to make $10,000. You have a leverage of 10, meaning you only put $1,000, the rest, the $9,000, is borrowed from the broker or one of their subcontractors. In such a situation, to avoid bigger losses than what you have invested, there is a price limit at which you are forced to sell. Here it will be $90 per unit. Why? Because if the unit price decreases by $10, we have 100 units multiplied by $10 equals $1,000, the amount you invested. This means that if the product loses 10% of its price, the broker will automatically close your position and you will have lost all your capital. How does Plus500 make money? Through spreads. The spread is the difference between the sell and buy price on each transaction. Through fees with inactivity fees, currency conversion fees, and overnight financing charges. Finally, through clients' losses. Indeed, Plus500 acts as a counterparty to clients' trades. Given the fact they don't fully hedge their position, they can profit when clients incur losses. Now, let's look at some metrics. One important fact is that the number of shares has fallen from 112 million in 2019 to 71 million today. At this rate, 10 years from now, I might be the only shareholder left and I would become a director. We can dream, right? As we can see, all their key metrics look strong. ROIC and margins are really solid. The only weaker spot is growth, but that's expected to vary a lot from year to year. Given the fact it's a trading platform, its revenue depends heavily on market conditions, which can change a lot from one year to the next. Now, let's discuss about their Q2 2025. As we can see, an important metric for a trading platform is the number of users, and we see that during this semester, the number of new customers increased by more than 50,000. Moreover, we can see that these clients are well geographically diversified, with 50% coming from Europe and 50% in the rest of the world. Another key metric as a trading platform is user longevity. How long the customers stay active on the platform. And as we can see, the share of users who have been trading for more than 5 years has steadily increased over time, reaching 47% this semester. From their latest report, we can see that revenues, EBITDA, and earnings per share all increased. The only negative point is that the cash generated by operations fell. Looking at the financial statements, we can see that it's mainly due to changes in working capital. Specifically, the receivables increased, meaning that clients who owe money to Plus500 have not yet paid, while payables decreased, meaning that Plus500 already paid its suppliers. Overall, these factors had a negative impact on operating cash flows. Plus500 plans to keep growing by entering new markets and launching new products. Recent steps include the acquisition of Meta equities in India and securing new approvals to operate in the UAE and in Canada. They remain focused on shareholder returns, having distributed around $2.7 billion through dividends and share buybacks since its IPO. As a comparison, with the current market cap of $3 billion, it means that they have returned almost the entire market value to shareholders in just 12 years. Regarding risk and uncertainties, the biggest concerns are regulations, lawsuits, and competition. As we discussed, a lot of customers lose money on the platform, and some have complained over lags or interruptions in service, especially during winning trades. It's then possible that some countries will take further actions, especially to protect individual traders. For example, regulators already require Plus500 to display some warnings, such as 80% of retail investor accounts lose money. But if we describe Plus500 as a betting platform for price movements of stocks or other products, that comparison is not far off from clients betting on a sport or at a casino. Currently, there is an ongoing action lawsuit in Australia alleging that Plus500 issued highly leveraged CFDs which were not suitable for all investors. Regarding competition, we have other platforms such as IG Group or XTB, both of which have similar margins and also appear to be undervalued. It might be interesting to look at them too. Finally, looking at valuation, we can see that the current stock price is lower than both DCF and DCFNG values. As a reminder, DCFNG doesn't take into account the growth. Looking at the assumptions taken to compute the DCF value, we can see that the projected growth rate is around 26% for the next 5 years, which is not sustainable. The reason is because between 2019 and 2020, the growth was an amazing 250%. However, even without growth, we can see that the stock price still appears to be undervalued by about 80%. Then, is it time to buy? Only time will tell. Everything you will see or hear in my videos are my personal opinion. It's not a financial advice. You should do your own due diligences and research. If you found this content useful, feel free to like the video and subscribe to my channel. Thanks for watching and remember, don't waste your time, invest it.